Hi there everybody and welcome back to another stock analysis video. Today we're going to be analyzing the Clorox company, mainly because of the fact that, well, honestly, I don't know why it took me so long to analyze this company. I actually hold a lot of shares of this company in my personal portfolio, and I really wanted to know, well, what would be a pretty decent price for this company to buy it at? Is it a good price now, or is it way too overvalued? We're going to find out this episode. And actually, coming over here to the brands that they actually have, guys, they have, aside from the Clorox wipes and the Clorox sprays, they have actually a lot of brands that I didn't even know that they have. For example, the Brita Filter, Ranch, Pine Sol, King's Ford, Clean Paws, all of these brands they pretty much have under their belt. So they actually have a pretty good diverse amount of brands, and on top of that, what kind of other company makes these kinds of products? Not that many in my opinion. This actually gives them a pretty good solid moat. But now let's actually take a look at their actual numbers. Starting off, of course, with the dividend summary. Guys, they actually pay a pretty good dividend. A dividend yield of 2.66%, which ends up being $1.16 a share, which is pretty good. Annual dividends per share is about $4.64. Payout ratio in regards to their net income of 84.66%, which is very, very high. Obviously, this is in regards to the net income, not cash flow. Companies use cash flow to pay out dividends, not the net income, okay? So we're going to take a look at this payout ratio in regards to the cash flow using the calculator in just a second. 5-year growth rate on this dividend, guys, is 7.65%, which is pretty good in my opinion. Honestly, it will be hard to find a company with anything above 10%. Anything between 5 and 10% is pretty good in my opinion. They have grown this dividend for 44 consecutive years, which is very, very good. Ex-dividend date is actually coming up on January 25th, so you still got time if you want to buy this company at this price, assuming that they are a good buy right now. Payout is on February 11th, and they pay their dividends quarterly. Now coming over here to the calculator, we got the ticker symbol CLX, market cap of $21.5 billion, PE of 50.62, which is very high, guys. This, again, I like to buy anything under 20. So 50.62, almost 51. This is one metric. It's telling me that we are heading in the direction that this is overpriced. However, one metric doesn't cut it. We want to take a look at the overall picture. Share price of $174.93, and as we saw, they do pay an annual dividend of $4.64, which ends up being $570 million being paid out every single year, which is very surprising. Honestly, by this number, this is telling me that they do not have a lot of shares outstanding. This means that after this dividend is paid, that they are left with only $317 million in their cash flow, which is very, very low. And well, this pretty much shows it. This actually comes out being a payout ratio in regards to the free cash flow around 64.23%. It's obviously higher than what I normally like, which actually in comparison to companies like Kimberly-Clark and Procter & Gamble, this is still pretty low. But then again, they're only left with $317 million, which is kind of cutting it tight here. Coming over here to the metrics, guys, we got the net income 5 years ago of $701 million to 1 year ago of $710 million. Guys, that is an increase of 1%. And obviously they did have a really good year 2 years ago, and that's mainly because of the fact that we had COVID and everybody was using disinfectants, right? So that's essentially why they did so good 2 years ago. It kind of explains why they dropped so much last year, right? Less fear of COVID, more stuff were coming out, so it's, more information was coming out, so it does make sense. I don't know how they'll be doing this year. I have no clue. Honestly, I'm putting it as $937 million, but then again, I don't know. I just don't know. Next, we got the free cash flow. 5 years ago of $634 million to 1 year ago of $945 million. That is an increase of 33% with an average 5-year free cash flow of $887.8 million. And again, guys, we see the exact same thing. 2 years ago, boom, they had a massive spike. It's again because of the COVID, right? Because COVID happened. People were using disinfectants and all this stuff. So 2 years ago, they went up to $1.3 billion. And then last year, boom, it just collapsed down to $945 million. Again, I have no idea if they're able to continue this trend going up. I have no idea. Now, here's the thing though, when it comes to this, are people going to buy other brands that aren't Clorox? I don't think so. There really is another company that makes anything in the likes of like Clorox, right? You only just think of Clorox. Whenever somebody says, oh, give me that disinfectant, people always give, Clorox, right? So it kind of is like a little bit iffy when it comes to these numbers, but then again, you have to think of the company's moat as well. Next, we got the revenue, and this is actually looking very, very good. 5 years ago of almost $6 billion to 1 year ago of $7.3 billion, which is an increase of 18.64%. Very, very nice, smooth and steady line. I think they'll be able to continue this increase into my projections. Next, we got the total debt. And obviously, we want a company to have little to no debt, or at least be bringing down their debt by a significant amount. Clorox, however, as you can see right here, not doing that. 5 years ago of $2.2 billion to currently of $3.2 billion. That is an increase of 31%. That is definitely really, really bad to see. Next, we got the shares outstanding, a metric that people don't tend to know a whole lot about. And this is pretty much telling you whether or not the company is diluting you as the investor. You want a company to be buying back shares. You want this to be going down. And as you can see right here, 5 years ago, 129 million shares to 1 year ago, or actually to today of 122.9 million shares, which is a decrease, guys, of 5%, almost 5%, at 4.96%. This explains why their dividend being paid out every single year is so low and their dividends per share is so high, because they just have so little shares out there that it really doesn't affect their bottom line, right? It really doesn't affect their bottom line when it comes to the cash flow, because most of this dividends, most of the shares that they hold, well, they're not going to pay themselves the dividend. They just don't have to pay it in general, right? So this benefits them to be buying back shares because they have to pay out less of that dividend. And lastly, we got the cash and equivalents, and as of today, they have $210 million in cash and equivalents, with an average cash and equivalents of $343.3 million. And now with all of those metrics, I'm going to be making a low, median, and high assumption. And I'm going to keep the required rate of return the same at around 10%, which is what the S&P 500 usually does. And I'm going to be changing the growth. For the low assumption, I'm going to say a growth of 3%. And this will come out a target share price, not adjusting for debt, of $113.76. For the median assumption, a growth rate of 5%. This will come out to be around $122. And for the high assumption, I'm going to say a growth of around 7%. This will come out to be $130.62. Now we need to adjust for debt. And this company, guys, has a lot of debt. They have been increasing it by a significant amount. We just saw this. So we want to take into account the debt just to be on the safe side. Adjusting for debt, however, this does go down by a significant amount. Target share price for the low assumption after debt is $89.40. For the median assumption, $97.60. And for the high assumption, $106.26. Now adding a margin of safety of 5, 10, and 15%. For the low assumption, we would ideally like to buy this at $76 all the way up to $84.93. For the median assumption, we would like to buy between $82.96 all the way up to $92.72. And for the high assumption, we would like to buy between $90.32 and $100.95. Guys, the current share price is $174.93. So this is right now is telling me that it's very, very expensive. Now, they obviously had a great year 2 years ago, but again, that's the COVID thing, right? That's the whole thing that was happening with COVID, and Clorox being a cleaning company, you know, obviously that they were going to do very well. In fact, I remember when this price was above $220, right? So it is what it is. Right now, this company is very, very expensive in comparison to the metrics that they're bringing to their income, to their cash flow, to all of this stuff. So that is essentially why I am saying that this company is very much expensive right now. Obviously, if you think that my growth assumptions are incorrect and you think that Clorox will be amazing or that Clorox will go bankrupt or whatever, I highly suggest you go into my discounted free cash flow calculator video and you make a copy of this cash flow calculator and you make your own assumptions. Because at the end of the day, every investment is the present value of all future cash flow, right? So if you think that I'm incorrect, then by all means make your own assumptions and figure it out. All I'm asking for, guys, is a subscription, a like, and comment on my videos, my channel. The calculator is free. That's all I'm asking for, is help support the channel so that way I can keep making videos and I can keep making calculators. I mean, I have a calculator to evaluate real estate companies, and granted, while that's not fully done yet, I would love to bring that out quickly because REITs are a whole other level. All in all, Clorox, good company. I think they have a pretty good solid moat. I just think that right now they're way too expensive, honestly. if you think I'm incorrect by this, then by all means, right? Make your own assumptions yourself. My assumption, I think that they're way too expensive. The PE tells me, and all of these metrics tell me as well. But at the end of the day, that's my opinion. With that said, peace out. Liked if you like, comment, subscribe. It really does help here with the algorithm on YouTube. You can follow me on my new tech sites at BitChute, Odyssey, and Rumble, where in addition to my stock analysis videos and crypto videos, you will get exclusives as well. And only on Rumble, I have a Let's Play channel. So if you would like to catch something that's not investing related, make sure to check that out. Alright, so with that said, peace out and be on the lookout for the next stock analysis video.